Everyone here who's been in the fintech space for a while knows our next speaker. He has been responsible for rapid growth now with two different companies. His second act is in many ways, I think, a bigger, a more audacious goal than what he's done before. He is really looking to do something that's never been done before, securitization on the blockchain, doing not only that, loan origination on the blockchain, and it truly is quite amazing, I think, just a fairly short time, how they've really come into their own. So why don't you please join me in welcoming the CEO and co-founder of Figure, Mike Cagney.
Wait for the soundtrack to finish. So I'm going to talk about blockchain today, and specifically I'm going to talk about blockchain as it's applied to financial services. And to start off, I just want to talk a little bit about what blockchain is. And there's a couple of different forms of blockchain, and the way that we do this is very specific, starting with the concept that there's proof of work and proof of stake. And proof of work are blockchains like Bitcoin that have traditional mining functions. Proof of stake are consensus blockchains that have a medium in which people agree on what is true and post that into the blockchain. There's very controversial public versus private blockchains. The blockchain purists don't believe in private blockchains. They think it's somewhat orthogonal to the spirit of the blockchain. But the reality is, within the financial services domain, if you don't have some permissioning structure, how do you control for KYC AML? How do you control for investor accreditation? There's a whole bunch of limitations that lead private to be a more preference structure for financial services. And the last are smart contracts. I'm going to talk about smart contracts today. Smart contracts are a name that we created to make things look more interesting than they are. They're just traditional stored procedures. They're pieces of code that sit on the blockchain and react to certain things that happen. In terms of the characteristics of blockchain and why it's relevant, if you think about, first and foremost, trustless data. So the underpinning of most blockchains is the concept that every time you put in A, you will always get B. And you don't have to trust that A is true. So think of this analogous to an underwriting process, that I have a FICO cutoff. And what I'm doing is I'm submitting in a credit report signed by the credit bureau, so I'm not doing any attestation that that's true. And every time, if I have a 680 cutoff and it's a 660 FICO, it's flagged as an exception. So trustless data is one of the important underpinnings here. Immutable history is critical as well. So whatever I create is never changed. And so this way, you're only appending into the blockchain. It's not like a database where you go and you rewrite a loan rate from 6 to 8, or you rewrite an income number from 100,000 to 110,000. All the information on the chain is immutable. And most importantly, it's distributed. And this is an interesting aspect, and I'll talk about why distributed matters when I get to the function of the blockchain in specific examples. But the idea is that this information is held by multiple counterparties in disparate resources, disparate spaces. So there is no one instance of the blockchain. There is no one instance that could be hacked or executed on with malfeasance or so forth. In terms of where this gets powerful, why it matters, when you take that concept of trustless, immutable, distributed, and you bring that together with the function of a ledger, a registry, and exchange, you create a foundation that has the ability to transform a lot of what we do in the financial ecosystem. So most notably, the ledger is providing a mechanism to give you an auditable trail of all activity. The registry is providing the concept of ownership, which is critical. And the exchange provides a medium to very effectively and without friction transfer that ownership. So when you bring these things together, you have something that can be relatively significant. And what I want to do is demonstrate how this works within securitization. This is something that we're doing today. And if you think about the securitization market, it's $3 trillion globally, primarily in the US. It's laden with costs, inefficiencies, challenges. So most notably, even at the very beginning, when I originate assets and I think about how I perfect them and pledge them into a warehouse provider, it takes 3 to 7 days to do that pledge. It's relatively inefficient. When I go to securitize, I'm paying auditors, trustees, custodians, traditional intermediaries that sit in between the transactions, sort of classic rent seeking. When I create a securitization bond, if there's any underlying credit related to it, it's relatively illiquid outside of when the remittance report comes out and therefore suffers from illiquidity. So there's a lot of opportunity to do things better within the space, and blockchain uniquely is positioned to provide some of that opportunity. So I'm going to walk through how it works today, what we do on Provenance. So Provenance is a distributed stakeholder blockchain that we built as part of Figure. We've spun it out now independent of us. But effectively, the first process is just being approved to use the blockchain. This is that permissioning aspect. So if I want to put a loan on the blockchain, there's an administrator that's responsible for looking at my lending licenses, my promissory note, all the things that are critical for me to perfect collateral. And so that onboarding process is the first step in being able to engage and leverage the chain. Once I'm approved and I can use the blockchain, basic structure, originating a loan. So if you go back to this concept of trustless data, what I'm doing is I'm putting up a loan packet on the blockchain that has all the inputs. So for me, I originate HELOCs, and I do that on chain. So I'm sending credit, property, title, all digitally signed by source. And so I'm not having to attest or represent that any of these things are true. Each of these stakeholders that we have, these are financial institutions that range from buy-side to sell-side firms to certain players in the ecosystem. Each of them has not only a copy of the blockchain, but a set of smart contracts, including one specific to my underwriting box. And so if, for example, I've got a 680 FICO cutoff or an 80 CLTV cutoff, each of them is taking the information I submit on the chain and making an assessment as to whether I've done what I said I would do, and recording that in their independent blockchains. Now, when I say they're doing this, it's not that they're actually looking at the data, it's just the smart contracts they're hosting. And in fact, the data that goes to them is encrypted, the data they create is encrypted, and so they don't have any privy or access to information, they're simply satisfying the need of having a distributed representation. Where it gets complicated, and one of the critical things that you need in blockchain is you need some sort of bridge to fiat currency. So I need to represent that I funded the loan, for example. And so the way that I do that is we have a set of omnibus banks. And these banks act as a bridge between blockchain and fiat. And if I'm funding a loan for $100,000, I push $100,000 into that omnibus bank. It delivers a token to me on the blockchain that represents that $100,000. I sell that back to them with the instruction to fund the loan, and therefore memorialize the fact that I funded. And conversely, 30 days from now when the loan pays, the opposite happens. The money comes into the omnibus bank as a payment. There's a token delivered to the blockchain that represents that payment that amortizes the loan. The loan holder redeems that out for cash, and effectively you capture that action. So why does this matter? It matters because you're creating a perfectly immutable record of that asset provenance. So I know whether I originated it correctly, I know whether it's performed. Because it's a registry, I know whether it's encumbered or not. So if you extend this to trading loans, today when we do trading of loans, we go through an enormous offline process. You might do a QSIP wrap and settle through DTC. You might put them in trust and settle through trust certs. If you're in Europe, you might use Euroclear to do it. It's costly and it takes time. So how does it work on blockchain with blockchain as a registry? Well, if you want to buy a loan from me for $100,000, you simply push $100,000 into that omnibus bank. It's going to deliver you a settlement token on the blockchain that represents that cash. That settlement token is immediately exchanged for the registry of the loan from me to you. I now have the token, you're now the registered owner of the loan, and I redeem that token out, pull the cash out of that omnibus bank, out of the escrow account into my account. And what we've just done is a real-time transaction. So we've traded with no counterparty risk, no settlement risk, instantaneous settlement. You could literally take that loan and 1 second later sell it to someone else or pledge it to someone else. And so this introduces a huge amount of efficiency for what's traditionally been a very arduous process. And if you extend this from trading a loan into the concept of warehousing, it's the basic principle, same principle. So rather than selling you the loan and encumbering it or changing ownership to you, what I'm doing is I'm pledging the loan and encumbering it to you. And so if you think about processes that we have today, it takes 3 to 7 days in general to perfect collateral into a warehouse provider. That warehouse provider is paying for a custody agent, a payee agent. It's a relatively time-consuming and burdensome process. On blockchain, it's literally instantaneous. I simply just encumber the loan, release cash. It's now encumbered. I can't sell that loan. I can't pledge it to someone else. And it creates a much more efficient, frictionless process. So if you extend this into securitization, the securitization process is also very straightforward. You bundle a packet of loans together just like you normally would. You still have your 144A documentation for private transactions or public for public transactions. You create a set of security tokens that are specific to the waterfall that you're building off that blockchain, just like you would with bonds today. And you offer them up for sale. And the process of administering that is now the function of a smart contract that takes those payments in from those loans that underline the bonds and determines how to allocate them into that waterfall. It could be serial, it could be parallel, it could be as complicated as you want with turbos, et cetera. The process is all being handled on the chain. And so if you think about where this translates to real dollars, so first and foremost, think about origination and aggregation. So we've markedly reduced our origination costs on the HELOC side, notably the QC costs, the audit costs, the processing costs, and using blockchain technology. There's 100% certainty about what we're originating and how it conforms as it goes through. Our warehouse providers have substantially reduced their costs. Roughly 70% of their costs have gone because they can take collateral as we originate it. We're not waiting 3 to 7 days where we're balance sheet financing. They're getting faster turnaround and more efficient processing, and they have smart contracts they can manage for things like concentration. So I can only take 25% sub 680 FICO or only 30% California, et cetera. And so it introduces huge efficiencies there. We've measured it out to be somewhere between 25 and 50 basis points of value between the ecosystem. Deal costs. When you securitize, you bring the question up, do you really need someone to come and audit all the loans since you know what they are? Really, the auditing can happen at the smart contract level, not the loan level. Do you need a custody bank? Well, not really, because the blockchain's a custodian. Do you need a trustee? You need a legal trustee, but you don't need a payee agent. So you can cut down somewhere between 25 and 50 basis points of what's typically a 100 basis point fee in a securitization transaction using blockchain. Ratings themselves. So there's a white paper that we have that we released today, and we had some contribution from a couple of the rating agencies in it, specifically around the idea that blockchain should provide a foundation for rating enhancement. And the rationale for that is twofold. One, you have true data certainty, and you could counter that when you do a traditional transaction, you're auditing to demonstrate that certainty. And those of you who've been in the ABS space know that auditing is less than perfect. But more relevant, because blockchain's a registry, you know who the bondholders are in a transaction. And if you think back to one of the issues we had in 2008, where the trustees really failed in that process, was we had all kinds of situations where we needed bondholder quorum for modifying collateral or changing servicers and so forth. And they weren't able to find who the bondholders were. They weren't able to generate those votes. And the rating agencies were very vocal about the fact that that's a huge hindrance within the ABS and securitization space. And so within blockchain, you have that certainty and that knowledge. And that's a great foundation to provide a path for rating improvement. And finally, around improved liquidity. And this ties into the remittance report structure I talked about before. When you're waiting 30 days for a remittance report to come out, your bonds aren't trading during that period. The remit report comes out, you rerun Intex, and you have 2 days of liquidity. In the construct of blockchain, you have real-time visibility to collateral. So if it's, I don't know what time it is right now, but call it 10:30 on a Monday, I know every loan that's paid me today that should have paid me as of 10:30. And so with that real-time visibility of collateral, you can rerun your analytics, you can have certainty in terms of bond pricing and bond value, and therefore create much better secondary market liquidity. And that yields to better deal execution. And what we're seeing is something like 100+ basis points of value on that efficiency. So in aggregate, you're talking 150 to 200 basis points in a $3 trillion a year ecosystem. So it's an enormous market opportunity. And these are things that we're actually realizing. These aren't hypothetical. So when you apply this to the larger construct, we talk a lot about securitization, but there's actually a bunch of things we're doing on blockchain. So we're moving funds on blockchain right now. We're looking at doing debt issuance on blockchain. There's some work that we're doing around title on chain. You can go across a variety of different asset classes, a variety of different markets, and you can see there's an enormous amount of opportunity. This is probably what we consider the most transformational technology to hit the financial ecosystem, probably since the spreadsheet, if not even more transformational than that. So this is going to have a massive impact across virtually every market that we occupy or participate in. And so one of the logical questions is, what's in it for the blockchain? And this is a little bit of an issue around this whole concept of tokens and tokenization and so forth. And we have a very specific view around tokenization. And in particular, I get a lot of people that come to me about tokenizing assets. I'm going to use the blockchain to use a token to represent an asset that doesn't live on the blockchain. This is one of my creative people's idea of doing art with blockchain. And the premise is relatively straightforward. So for example, I'm going to take my Picasso and I'm going to sell you 20% on the blockchain. The challenge is that token isn't an enforceable contract, and you can't have certainty as to the underlying asset it's supposed to represent. So what if in that construct I sell my Picasso? What do you do? Right? You sue me, but that's a relatively burdensome process. And the fact that you have to trust that there's collateral representing that token is a little bit orthogonal to blockchain. So the way we think about tokens is we think about them in the construct of both governance and economics. And specifically with provenance, provenance has no owner. It has no corporate structure to it. It's a blockchain. It's out there in public domain. Anyone here can use it. When you use provenance, that administrator is setting a cost to access and transact on it. That cost is a third of the fiat benefit. So if I'm going to save $300 to use the blockchain, I'm going to pay $100 to access it. That $100 that I pay in is effectively distributed to the stakeholders in the blockchain, the nodes to generate a return on their stake. It's distributed to the administrator to cover their costs, but most of it goes to the token holders. In our case, it's called hash. That's the name of the token. And so what hash really is equity on the blockchain. So you can think of it as a company that has no costs and dividends everything out immediately as soon as it earns it. And what this does is provide a very interesting and egalitarian structure to participate in the economics, because every hash holder has the same pro rata rights as every other. Think about this in parallel to equity. Tokens can't be created or destroyed. Tokens provide immediate yield, immediate access, and visibility to revenue paid in. So it's like a top of revenue play versus a net income play. They provide governance. So the administrator board is voted on by the token holders. They set and drive that board. That board has relatively limited capability because it really just sets the economics and access to the blockchain. And so in looking at this, it's a more, what we think, elegant structure to participate in economics than a traditional equity structure in a way that passes value through. So what we're looking at this year is we've been originating HELOCs on blockchain since fall of last year. We warehouse finance them, we sell them to banks, we sell them to funds. We have a relatively large ecosystem that participates on the chain. We're in the process of doing a private securitization right now with a public securitization, a rated transaction behind that. Those will both happen in Q2. And so we think that we're going to be able to start demonstrating something real and significant here. And this is important because the way that we look at this token on blockchain called hash is we think it's a security. So if you look at it in the traditional Howey construct, and this is very popular right now among SEC pundits, it yields and it behaves like a security. It should appreciate in value as the value of the participation in the blockchain grows. And so one of the big pushes that we have is we want this to be a public security. So we want to do an S1. So rather than an ICO, we want to do an IPO on that underlying security. And a lot of people have asked me, why do I want to do that? And it's got nothing to do with liquidity because the token already trades today. And it's got nothing to do with market value because we think the market value is intrinsic to the adoption and use case in the blockchain. It has a lot to do about the regulatory authority. So we would like this to be a public security because we'd like this blockchain to fall under the provenance, the domain, no pun intended, of the SEC. And we see this as being important because we're trying to build a transformational technology platform, and the single greatest barrier to adoption of new technology within the financial ecosystem is the regulatory aspect. Right behind that is the cost to adopt. I think we've addressed the cost to adopt, and I think by getting the regulators behind this, we're making the regulatory burden a lot easier as well. So look for some pretty significant things to happen this year on provenance, on blockchain in general. And not just us. There are a lot of other really interesting blockchain projects out there. And I think what you're going to see over the next 1 to 2 years is a movement away from the concept of everything being rooted in crypto and everything being rooted in Bitcoin and around real business applications that deliver real tangible value to the broader ecosystem. So it's something you want to get involved in. All right, thank you.